Sorry, this is not meant as a sign. We always say escrow fell out, which means it's escrow's fault. But sometimes it's underwriting guidelines change. Sometimes it's situations with the buyers change, or the property doesn't qualify. Talk a little bit about your underwriting guidelines and the process that once the loan app is in, the process that you have to go through in order to get to docs.
That's a very long question. That's a very long question.
Just don't read it.
Okay. The process from loan application to docs, well, how do we even begin? So, offers, they sign the disclosures. From there, we cannot order the appraisal until we have signed a signature on the disclosures, because that gives us the permit. They want to proceed, intent to proceed. From there, we order the appraisal.
You're talking about the rate and term disclosure? What
Or I'm talking about the 50 or 60 pages worth of government gobbledygook.
Got it.
There's about 50, 60 pages in there. I always say there's about 3 pages that you want to read, and the rest of it is you can basically look at the title and get an idea. But we go through all of it. But once you go through you sign the disclosures. That gives basically just the open-ended. This is what we know so far, and we're going to get it more narrowed down. And here's all the legal things I need to let you know. If you don't make your mortgage payment, you're going to get something bad on your credit report. Oh my gosh! If I borrow money, I'm expected to pay back the money that I borrow. Oh my gosh! All these fun things that you need 50 pages of paper to understand. Once we get permission by those signatures to order the appraisal, we are not allowed to charge anything until that happens. So that's why we wait for that to actually order the appraisal. Then we have to order the appraisal. That takes 7 days. During that time, we order verifications of all the different things in there. All the different things in the file can be broken down into 4 areas: income, credit, assets, and property. Everything that we could possibly want to know falls within one of those areas. For the borrower, the 3 areas are just making sure, number 1, that anything on the credit report that's not clear needs to be verified and corrected or updated. Anything on the income, we need to make sure that they didn't Photoshop anything on their pay stubs, that their tax returns weren't Photoshopped. Photoshop is our biggest problem here. Making sure that everything matches, making sure when we verify their employment that they haven't quit their job. And then we have to do that again within 24 hours of funding, because they do quit their job 24 hours within funding time, which is another story. And then assets, making sure that their bank accounts are matching what they say they have, verifying any deposits that they've made, or all this paper trailing stuff. The process from our bank is a little bit different than how the flow works once we start the process, though. So from us, once we submit the file, it has about 24, 48 hours of time where they do a very brief checklist on it, and then it goes directly into underwriting. And then underwriting will take about 4 days. From there, we are able to release, give a full loan approval, conditional loan approval within a week to 10 days.
So conditional.
Conditional loan approval, meaning the underwriter says yes, as long as you do these 20 items or verify these 20 items, which could be as simple as need an updated pay stub. It could be as complex as complete your divorce if they haven't done their job. If the loan officer hasn't done their job right up front, for example. A lot of times we're submitting files so quickly that we don't even have escrow fees in or title fees in. We don't have the appraisal back yet, but we have all the major stuff like income, credit, assets. Those have been reviewed by an underwriter and say once you give us the green, these are verified, you're good to go. From there.
I think you killed it.
Did I get it? That's what
job.
you're looking for, right?
You did a great job.
And then we just fund, and then we go have a beer. That's it. Yeah.
The beer part's my favorite part. So, Duane, back to you. As agents, we're required to do an agent visual disclosure, inspection disclosure report. And a lot of what we look at, we're supposed to disclose things that are obvious. Give me some of your advice, or give them tips on some of the things they should see, should notate, and the best way to disclose, given that they don't have an expertise.
Absolutely. The AVID, Agents Visual, that's something that I guess is fairly new. It lasts, 4, 5, 6 years it's started, and I see that a lot. Agents will walk around and sometimes will ask us. What I like to think is the best thing to fill out on that form is things that are obvious to you. You know, as you're walking around, if you see cracked tiles, you know, on the kitchen counters, you know, put that in there. Obviously, I think agents know that you're supposed to have smoke detectors and CO detectors. Put it down. Anything that just jumps out at you and that's obvious, I think it shouldn't be something that's stressful or very complicated for you to do. I think a lot of times when you go out and do your caravans, you're looking at houses to see if they're suitable for your buyer. Well, a lot of times, you know, if your buyer wants a turnkey home, or if they want a home that's not so turnkey, and then you're going in and you're actually inspecting houses. So in a lot of ways, you are inspectors. So, you know, just report the obvious. You don't try to be a property inspector and you know, tell us all the things that are wrong with the installation of a water heater. It doesn't have straps. I mean, you know, put some straps on the water heater.
T&P valve doesn't have a downline.
Right, right.
Okay, good. Thank you for that.
Can I just add in there? Sometimes we have issues if you're asking for repairs or something like that, and you relate it back to the Avid. Then if you do that, then I have to ask for the Avid to go into the file, and I don't want my underwriter to see that. So don't refer back to other documents, because then it triggers us to have to ask for that as well.
So for you, as agents, probably the number one most important form for you to do is the Avid. And I still get Avids that say nothing to disclose from very high-end brokers. And it just really, really frustrates me that we haven't gotten that importance out. When I do an Avid, I go through every single room and I find something in every single room. And I take a picture of something I find, very much like your report, and I attach that picture to my report, and I provide it to the buyer. To me, and it could be something as innocuous as a smell. You could walk into a room and it could have a very foul odor, and if you don't disclose it, and it ends up being mold, or it ends up being something else undesirable, or that impacts health, it creates a great liability for you. So don't shortcut that, I guess, is what I'm saying, and don't rely solely on the inspector, because his job is different than yours. Make sure that you go through and you physically touch every single room, you know, and that you document what you see.
I mean, it's obvious. If a door doesn't close, you know, if there's stains on the ceiling, just put it in there. I mean, it's, you know. So
let's talk a little bit, Pablo, the difference between insuring a single-family home and a HOA or PUD.
Okay. Well, with the PUD or condo, if we're talking about a master policy, okay? So the master policy is going to cover the structures, okay, for fire insurance. So God forbid there's a fire, then we're talking about the master policy covering for fire. The master policy also has liability insurance. Usually, we're looking at about $1 million per occurrence, maybe $2 million aggregate per year. It could change, but that's usually. Okay? And then another important coverage is officers' liability, because you have people that are handling money. And so depending on the number of units, it could be quite substantial. Thank you. And so that's what happens. If we relate that, let's say, to a condominium policy, the condominium policy can be either for a renter or for somebody that lives in it, okay? And that condominium policy will usually insure within the walls. It's not talking about the structure. But it's important for everyone to have it because of the fact that it has also liability. And it also has one more thing that's really, really important that a lot of people don't talk about a lot, and you know, it's happening more and more, and that's loss of use, which loss assessment, which what happens is, let's say that God forbid there was a major issue with the master policy and there was a liability claim, okay, and that liability claim went beyond the policy limits. Now there's going to be an assessment, okay? They're going to assess every single owner, and that can come out of that for liability. On the, for structure things, they may say, okay, well, this is a maintenance situation, and you're still going to get assessed, but at least you have the coverage. You can open a claim. You can let an adjuster look at everything so that they can, either accept or deny that particular claim. But it's extremely important for liability, especially if you have swimming pools. It usually arises from the common areas, okay? Jacuzzis, if you have rec rooms or a community room, if you have a weightlifting room and somebody gets hurt, a lot. So to a certain extent, all of us are liable that live in that complex to a certain extent. Don't go worrying about it, because all you need to do is make sure that you have a good master policy, go to your meetings, be proactive in that, go to the meetings, don't miss your meetings, make sure that you get a copy of your CC&Rs so that you can read them and see how they work and so forth and so on, but it's very important, okay, very important, okay? The homeowner part, you're not associated with an HOA thing, so it's a little bit easier, it's covering the structure, liability, theft, medical. It's supposed to be a deterrent from a lawsuit, so that's an easy thing. For the master policy, we take a little longer. We need to figure out if the previous agent insured it properly, and sometimes they're underinsured, so it takes a little bit more time. But the liability part is what we all have to worry about, because that's where the lawsuits come in. Especially if the CC&Rs say, and I don't think that they can say this, you could probably tell me, but if this, because some people don't want to rent with people that have dogs, right? And so I don't think that you can do that by law, right? You can't. And so
there's people that they put in their rental that you can have a dog like 10 pounds or less.
okay.
So it's a specific type of dog, but they're not discriminating.
But I've never seen that on the CC&R, so...
No, the association can't make that determination. An individual homeowner or investor can. You can say, I want no pets, or I'm limited to certain pets.
right.
So they have that flexibility.
So, common sense, the liability part, be involved, in your association. When there's a meeting, don't skip it. Go, because they could be voting on something that you don't want necessarily to pass. There was one particular one in Chino Hills, and they voted to change all the plants, and the plants were perfectly fine, and the assessment was huge, and everybody started screaming, but nobody went to the meeting, so nobody blocked the vote. And it ended up being that the people that voted for it owned a gardening company.
Oh.
So, you need to get involved, and you need to go to the meetings and use your common sense, and then if you have any questions, ask the people that that have been in business for a while, talk to everybody, get some opinions, and, we all are here to help each other. I need you guys as much as you guys need us, and I need them, and they need us, and so we're all in this same boat together. Use your common sense so that you avoid issues.
Thank you. I want to stay on the HOA thing for a bit, because the HOA finances, the HOA master policy, the HOA governance docs are all areas where a deal could fall apart because the lender could disqualify a property. So I know every loan has its own guidelines, and so they vary, but on a general scheme of things, what is the underwriter looking for when they look at those HOA docs?
So a couple things that they're looking for, just to wipe it off the table real quick, if the buyer is an FHA or a VA buyer, those condo complexes need to be approved by them before you put an offer in, so you can wipe those off right off the bat. In terms of the kind of things that the underwriters are looking for, number one is litigation. They want to make sure that the HOA is not getting sued right then and there. They want to know that any litigation is not health and safety related. For example, a condo building, multi-floors, and they're being sued for something relating to an elevator. they've got issues with that. Also, they're going to want to make sure that the concentration of investor versus owner-occupant is not over 50%.
Yeah.
Once it crosses that threshold, it falls into a non-warrantable condo, which is code for more expensive to finance. So that creates a whole other issue. You want to make sure, if you figure that the value of a condo is so interdependent upon how well everybody else in the complex is taking care of it, and if everybody in the complex is renting, it's not going to hold its value as well as if everybody in the complex is there and they're all retired and just gardening in front of the complex all day. It's not going to look as good. So that's why they want the concentration, and then they're going to want to make sure that the HOA has enough reserves and there's not too many people behind on their HOA dues to make sure that it's not going to trigger a big reassessment and the payment's going to double on the buyer, and we're going to have to, and they don't qualify once that happens. So those are the couple of things that they're going to look at.
So as a practitioner, how would I know if a condo complex was FHA approved or not?
There is a website where you can pull it. It's doesn't work very good, and believe it or not, the computers go to sleep after business hours. So it actually, you can't pull condo records on after hours. It's weird. But basically, if you know you're going to be searching in a certain area, contact your lenders / me, and I can go ahead and pull up all the complexes that are FHA approved or VA approved in the city that you're looking, and just give you that. I pulled one for San Dimas, and I think there was 2 complexes.
Yeah. In Chatsworth, where I live, there are 22 condo associations in the area, and only 7 are approved. So it's not automatic that you have that.
Yeah, and you got to be very careful if you do go on the website and you are looking there. Even though it says approved, you got to look at the date that it expires. Oh yeah, this one's approved. I checked it. Yeah, it expired 7 years ago though. That's a problem.
Yeah.
So one thing you can do is you can go to the president of the association or one of the officers and get the CC&Rs. If they're running away from you, if it's very difficult to get a hold of these people, that should throw up a red flag that you need additional help, like maybe from a lender, a realtor, a title, because if they're hiding, if it's difficult for you to get a hold of them, that should be a red flag that maybe something is going on. See, common sense again. You follow? Just try to get a hold of the person. If the person is not answering your calls or is taking forever to get back to you, how are you ever going to resolve a problem if something arises with those officers? So that's a good way to gauge it, and then ask your realtor, your loan officer. Don't ask me because I'm not getting involved in that.
Just by single family to make
Just
my
I was
life
going to
easier.
say something about the HOA. A lot of clients call up and ask, who is the association, who is the HOA, and how to get a hold of them. Title only goes by what is recorded a public record. The only way that we can find out who the HOA is if there's a lien against the HOA, then it's recorded. Other than that, we don't know who the HOA is.
Yeah, that's a challenge, and we addressed that a few years ago. I was on a committee at CAR, and we tried to force HOAs to register who their management companies were, who the contact people were, and put it out in the public domain so that we didn't have to go through those challenges, and we couldn't get it passed. And actually, the funny thing is, the Secretary of State is required to have that information, but the Secretary of State doesn't want to spend the money to accumulate and publish that list. So somewhere out there's a requirement that's not being met because the need hasn't been deemed enough.
Well,
So-
what you do is you knock on the doors of the condominiums and you talk to the owners. Hey, how do you like living here? And some of them will give you horror stories, and some of them will tell you it's all okay. You knock. You're going to make an investment, right? So, if what he just said shocks me, I'm learning here too. So, they don't report it. You have no way of figuring out unless there's a lien against it, right?
You
Knock
can
on the
Google.
door.
You can try to see if you can Google something. See if it's
Typically,
online.
the homeowner knows who they're paying their association fees to, and
Exactly.
and so
Right.
typically that's going to be your best resource.
Exactly.
And absent that, then as a practitioner, I might go in and look and see who's sold homes recently, and contact that agent and say, were you able to determine who the HOA was? Obviously, they did if in fact it closed. So